Okay, we'll just give it a couple, 30 more seconds just to wait for everyone to log in. We're just on the hour, so. Just a few more seconds, we'll get as many numbers on as possible at the start, and then we can start talking through the information. So I'll start getting into the detail, just some introductions to allow more people to log in. We've got over 900 delegates, I think, registered this course. So that's it's great news, and so good day to everybody. And thank you everyone for showing your interest in our analysis. Both Robbie Tanjang and myself are here together actually in person. We're actually in Atlanta, Georgia. And over the next 50 minutes, we'll be taking everyone through the latest Odyssey performance numbers. That's benchmark figures based on the 26 Odyssey funds. And we align that performance data, which we're grateful to receive from NCREIF, with our own valuation data set to provide a bit more added intel into the market trends. So this webinar is kind of a market oversight. It's also kind of a precursor to the one-to-one client conversations that we'll be having over the next series of weeks. Just a quick word of thanks to everybody. It's a kind of collective team effort to get all of this information together. So kind of big thanks to our wider advisory network which work around the valuation data, to my own performance team, and obviously to the clients providing us with privileged access to their information. Robbie, we kind of finished last quarter with a polling question, so maybe we should kick off there.
Phil, if you go next slide, right? So basically, I think on the previous quarter, we asked what is a total unleveraged return to be in 4Q, right? So I think this is kind of what the polls show. Majority basically choose between -2 to +1. So basically showing appreciation between 0 to -3%. And the second bigger portion is basically -4 to -2%, right? So Phil, what does that look like on the fourth quarter?
Okay, so just to qualify, what we're focused on here is the unleveraged, as it said, property returns. There's no leverage, no cash, that are the numbers that we'll be digging into, and then it's a total return that we were polling around there that we'll kick off with. So the overall return did more come into that bracket there, the third bracket down, and just to put the numbers out there, my slides will move on. Came out at -3.99%. So kind of coming a little bit below a lot of people's expectations. -3.9 drops to -4.1 when you take out the impacts of developments. But I guess the ongoing decline that we're seeing into Q4 will come as no surprise to most folks that are dialing into this, given the kind of continued uncertainty around the economic backdrop and that increased cost of capital, which is collectively putting downward pressure on the market. And you can see there in that right-hand column, negative returns across the board. So no one sector was left unscathed, so to speak. This table does, though, show how quickly the market has been scaled back. I mean, in the space of the last 12 months, real estate in the US has pretty much been turned on its head when you look at the Odyssey numbers in more ways than one. In terms of absolute returns, in terms of how those returns are shaking out across the sectors, but also the spread and the divergence in performance levels. A year ago, we were kind of waxing lyrically about record-breaking levels of returns, which remained in the kind of 6% territory in the opening 3 months of last year. You roll forward to the year end, and that's a 10 percentage point swing in the space of 9 months. So what about the performance shake-up across the sectors? So we're color-coding those sectors here in relation to the overall Odyssey operating average rate of return. So greens above that, greens, reds coming in below. Apartments and industrials, which started the year as the two main growth sectors, have since experienced the largest scaling back in returns. And in Q4, they're pretty much suffering in equal measure, minus 4.1% level pegging, and key components of that overall reduction in the ODCE return. Offices have finished further adrift at minus 5.8, whereas retails, while still on a downward trajectory, have held out comparatively well, as to a certain degree have these alternative real estate assets in that other bucket, most of which is self-storage. This isn't the newly defined other categorization. NCREIF is still doing some finalization on that data, but we will kind of break this apart in a bit more detail and try and look at things like the life science, the MOB component, and how that might be playing into the office sector as well. So the challenges facing real estate are pretty broadly based, with all parts of the market having contracted from a return standpoint. And while sectors are not being impacted in equal measure, the widespread nature of this latest performance setback means there's now really less divergence being played out across the sectors, and that's where this bottom sets of numbers come in. You go back 12 months ago, and you've got double digits, 13 percentage point spread from the top to the lowest performing sector. You get to the end of last year, and that range of variance in returns is down to more of a normal spread of less than 5 percentage points. What this means from a portfolio perspective is that more of the kind of return differential between a portfolio versus the ODCE is now going to be determined by the property specifics and less about the allocation plays. And portfolios with high industrial weights, less retails, would have back in 2021 had an inherent advantage. The variant is now very much more about how properties are performing within each sector, as opposed to how much weight a fund has invested in each of the different property types. And I've started to look through the different portfolios, and I've not yet seen a portfolio where allocation overrides the impact of property specifics. Sticking with that structural theme, and before we get into more of the detailed performance numbers, let's quickly remind ourselves of the makeup of the overall ODCE portfolios that we're analysing. So I wanted to look at this in terms of 3 staging posts. 10 years ago, on the left-hand side, where the portfolio structure sat at the end of last year on the right-hand side, and that middle chart is just before the start of the pandemic. So it's a kind of disproportionate time frame at play here. But what's notable is how much those kind of weights have changed. But what's really noteworthy is how much that change has occurred really since the onset of the pandemic. If you go between kind of 2013 to 2019, we're talking kind of 2 to 4 percentage point swings on an individual sector. But in the space of the last 3 years, since the beginning of the pandemic, portfolio structures have really been transformed. Offices and retails, the purple and the green, which accounted for just over 50% of portfolio values pre-pandemic, are down to around about just over a third. The retail allocation has been pretty much cut in half. And that reduced share has been taken up by the growth of the industrial sector. That's gone from 18 to over 30%. Retails have also been creeping up, but you also have the continual emergence of the alternative real estate piece as well. So a very different structural makeup to the funds now than what we were previously looking at. And with a lot of talk, I guess, about kind of ongoing office conversion, one that I suspect will continue to see set to evolve. Now, some of these changing weights will be down to investment trends, but the largest aspect is going to be down to the structural trends, is going to be down to the performance levels that have been playing out on a sector by sector basis. So that really comes into the fore on this next slide when you look at the divergence in trends on an annual basis since the emergence of COVID. So here we're looking at annual rates of return just to qualify, and they're kind of compounding the 4 individual quarters within each year, and then you've got the 3-year annualized on the right-hand side. And yes, thinking about Q4, we may have seen a bit of a change in regard then, but there's no denying from this the superiority there you can see of the industrial sector in recent years in the performance stakes. It also serves as a reminder of just how polarized the market has been. You get that back in 21, that's a 40 percentage point spread from the top performing to the bottom performing sector. In terms of the hierarchy, outside of industrials, this confirms that the other grouping is also a lead performer. In multifamily, it's come into its own since 21, continued to outperform in 22, but pretty much averaging out over on a 3-year period. Look down that 3-year column, the muted ones are the retails and the offices. Retail's having seen more of that negative earlier performing setback back in the start of the pandemic, but it's offices now, the sector, that are clearly being shrouded in uncertainty. So let's go back to the overall quarterly performance numbers. Break those down into the green, the income return, versus the appreciation element. This really just quickly shows how quickly the market has really been reversed in the space of the last year. A larger cutback in values, -5% that we experienced at the start of the pandemic. This chart also serves as a reminder of just how impressive that kind of post-COVID growth spurt, if you want to call it that, was. That's 7 consecutive quarters of growth that the market then experienced, during which periods values have risen by almost 30%. But then you can see on the right-hand side how quickly some of those gains are now being reversed. Now, if we overlay on top of this series, so the black series is the return series for the private markets. If you'll overlay on the top of that the listed sector, you can certainly see a more exaggerated set of results. So a more reactive story being played out here, and actually a story that's actually now starting to trend back into positive territory. And Robbie, I know that you've recently done some work around this, so maybe you want to share your thoughts on those major variances that are coming out of this slide between the private and the listed sectors.
Sure, thanks, Phil. I think yeah, so before I go to this slide, right? So just a reminder, as people have questions, please enter the question in the chat area, right? So then we can address them at the end, and either we address them at the end or we address them along the way as well, right? So or during the one-on-one with our client as well, right? So yeah, I think on this kind of private versus public, right? You look at it from mid of last year to kind of like later part of last year, when the REIT dropped significantly, there's a lot of question about private and public valuation, right? So if you look at it in here, there's definitely a different swing, right? So between kind of a REIT versus a private, right? So in here, I thought maybe take a chance to basically trying to open up a little bit the discussion about the variance of that too, right? So I mean, the high level basically on the private real estate is valued based on NAV, right? So being traded based on NAV, right? So versus public REIT are basically traded based on a share price, right? So one would argue that basically in private real estate, the valuation side might include subjectivity. On the other hand, as well, in the public REIT, you can argue this includes sentiment as well as speculation as well, right? So so there's definitely two different vehicles while I look at it, right? So if you look at as well, REIT, you're trying to correlate to S&P 500. The correlation are pretty high, right? So depending on which time series you're looking at, I see a lot of cases between 60% to 80% correlated to S&P, right? So and the other thing as well, there's a lot of article talk about private real estate is based on comp and based on comp only, right? So that's not fully correct either, right? So if you look at it on the NAV, there's a lot of due diligence, there's a lot of effort being put to come up to the NAV valuation, right? So there's multiple party involved as well, right? So you get the Altus group, you get third party, you get client, you get auditors as well, right? So private valuation, like a lot of cases, is done on DCF basis, right? So in a lot of cases, 10-year DCF, right? So it's incorporate a lot of information, right? So incorporate factual information, the rent roll, the operating statement, the budget, the capital, right? So and within that forecast, consider supply demand side for the market, right? So yes, transaction is one data point they include to basically determine the pricing, right? So the deal they go through, the deal they did not go through. We kind of consider financing as a fact of it, right? So also look at the survey, right? So again, there's a lot of due diligence, a lot of efforts being put into here. So, and then the valuation are typically done based on one specific date in time, right? So that's kind of one different thing as well, being private real estate versus public might incorporate some of the trading side of it, might incorporate some of the speculation or the anticipation of what will change in the future, right? So, yeah, so I think both investment are needed, like so they kind of get different time frame, different horizon, and they depend risk profile the investor typically prefer, right? So
thanks for qualifying that, Robbie. Let's just then just go back to the Odyssey return series and starting to break that down. So where it gets interesting is where you look at the makeup of that appreciation return and how that kind of rapid reversal has played out. So what we're able to unravel within AltUs using the valuation data set was how much that movement in value is down to a product of the pure economic fundamentals versus what might be termed the investor sentiment or the capital market side. So we're changing the red bars there for the red line, and then we're bifurcating those by the pricing versus the cash flow. So the pricing, the yield effect here is the impact of what might be termed the kind of, let's say, the pure pricing, the changes in discount rates, exit caps. That's the investor sentiment, the capital market side of the equation. For the cash flows, the blue bars were identifying the impact of the change in values from the change of those forward projected cash flows. That's more about the occupier demand versus supply side of the equation. And it's really the interplay between those two component parts that's led to that reversal of fortunes through the course of last year. The catalyst undoubtedly has been the events have been playing out in the wider fiscal markets with the movements by the Fed, increasing interest rates to combat rampant levels of inflation. But it's just how dramatic that change in capital has been over the course of the last year. The impact on real estate values started to be felt back in Q2. The Fed stepped up rates in Q3, and those fiscal challenges were even more of a headwind when we get into fourth quarter. Yes, 10-year treasuries may have moved back in the latter part of the year, but they're still massively inflated to where they have been in the last 10 years. And this has presented significant liquidity issues on the market, not to mention the challenges associated with the need to restructure debt as certain loans mature. But the overall value change also relates and is arguably as much about the cash flow side of the equation, or more so the interplay between the two component parts. So alongside the wider fiscal adjustments, there are clear challenges facing the overall wider economy. There may be diverging trends out there surrounding the overall economic health, but whichever way you look at the macro numbers, economic sentiment is certainly on the decline. There's definitely been a kind of swing around that during the second half of last year. The Wall Street Journal economist survey back in Q2 of last year showed a probability of recession in the next 12 months. I think it was at 44%, and by the end of the year, that probably had moved out to more than 60%. In the earlier part of the year, we're not seeing any real economic concerns at a headline level from a cash flow standpoint. Those cash flow levels, those blue bars for real estate, we can in fact continue to improve, and that cash flow metric stepped up in order of magnitude in the first 6 months of the year, ensuring appreciation was remaining very healthy. Roll forward to Q3, those cash flow gains, those blue bars are being scaled back down, but still providing positive support to values and cash flow gains that are still running ahead of where they were pre the pandemic. By Q4, those fundamentals, those cash flow gains continue to slacken to a point where you might describe cash flows as basically kind of holding their own as opposed to providing any real notable support to values. But so put simply, we really don't have enough growth in the fundamentals in Q4 to override the increases of those pricing metrics. This is an overall story. So looking at the movements and the effects of those yields and those cash flow adjustments, we do need to look at those across the individual sectors. So on the next charts, you want to be looking on the right-hand side of these. We shorten the time frame down a little bit so you can get more of a sense of the makeup of appreciation, how that's played out over the period of the pandemic. If we look on the right-hand side of these, the Q4 bars, the first point to mention is on that yellow offset. So the step up in order of magnitude of those yield adjustments in each of the four major sectors. And it's those growth sectors, the apartments and the industrials, that as we did see also in Q3, that are again being more affected in that regard. So seeing a 5 and a 7% pullback on values in that respect. And they're sectors that where, I guess, underwriting levels have been brought down to historically low levels, so arguably in more of a need of a reset. Office and retail yields have also been reset, but the overall outcome on appreciation over the last couple of quarters also comes back to that interplay with the cash flow side. So cash flow gains, those blue bars, have been scaled down on each sector, so across the board. Still accretive in most cases, but they're no longer providing sufficient support to provide protection to those values. Industrials are still ahead in the cash flow gain stake in terms of the size of that blue bar versus the other charts, but even here the kind of days of record levels of rental escalation look to potentially be behind us for apartments. Cash flow gains scaling back, so possibly affordability issues maybe starting to creep in there. Retails, yes, cash flows are still positive, so it's still progressing in the right direction, but only a slight uptick in terms of cash flows. So that's potentially households start to, I guess, tighten their purse strings. Offices is the one sector where cash flows were actually contracting, and clearly the kind of changing working practices is leaving the prospect of long-term excess vacant space for the sector. And in the current economic climate, the sector is also being challenged by some scaling back of business activities, all of which is inevitably putting downward pressure on those cash flows. You add in the rate rises, and this is the one sector with the larger write-downs in value. Quickly substitute out on that top right-hand chart the industrials for the other sector, most of which, as I say, is self-storage. Similar kind of trade-off as we're seeing in the industrials, a little bit more upside from rental escalation, balancing out some of that pricing offset, but a very similar dynamic playing out in that respect. But whatever sector you're looking at, it is the pricing, those yellow bars, that are having the biggest bearing on values, and that kind of comes through in that yield effect here, accounting for most of that negative appreciation. And let's relay that then to some actual valuation yield movements on the next slide, Robbie, and maybe you want to talk to this one to get a sense of where things have moved yield-wise, but also kind of where things are currently priced.
Yes, I mean, as we discussed previously as well, right, with the Fed tightening policy, the discount rate and exit cap rate have moved, right? So they have moved starting from second quarter on. So if you look at it, an overall discount rate have moved kind of as of kind of within 2022, it's kind of moved by about 50 basis point, exit about 30 basis point, right? So, and majority of that move is happening in fourth quarter, right? So, and again, part of it is basically the interest, the cost of capital increases, right? So, and during the fourth quarter, the treasury been super volatile as well, right? So you started with 3.6, hit all the way to 4.2, down to 3.9 at the end, and then at the end of the day, it's like, and then now it's about 3.5, right? So, so they definitely have a lot of movement on treasury and the limited financing, and all that part is kind of increasing in pricing, right? So generally the sector they're seeing the largest pricing compression the past several years, seeing the reversing of it, right? So that's why people are asking questions, why industrial seeing the biggest move, right? So part of it is industrial seeing the most kind of the highest compression. So they're seeing the reversing of that higher compression, right? So office continue to see that decline, right? So you're going to see office have both pricing movement, right? So it's been continuing on for a while as well, right? So, and then now you're adding on that pricing movement is basically the cash flow movement, right? So which what Phil going to talk about it. So.
Yeah, and that's the other side of the equation. So let's go there as well. So thanks for that, Robbie. So onto the cash flow side, which as I say, had been scaled back, but is still positive in all sectors with the exception of offices. And we relay that here to a series of 6 key valuation metrics. There are others also to consider, but these appear to be the major swing points. The bars show this percentage change in each of these metrics over the course. So just looking for the final 3 months of last year. There's no perfect science to this, so in terms they don't add up to the cash flow effect, but the color coding gives you a sense of what's having a positive or negative impact on those forward projected cash flows. So cash flows generally in the ascendancy, and we're still seeing kind of more greens than reds on the card here. Contract rents, market rents, all moving in the right direction. Industrials seeing a little bit more market rental uptick than other sectors, up at 4% there, which is helping them remain near the front in terms of those cash flow gain stake. But the face contract rents and market rents are being pegged back a little bit because those cutbacks, those forward projected growth rates, these are changes in the 10-year growth rates. So open those up below into years 1, 2, and 3, and you can see more of that kind of scaling back is in the kind of near-term year 1 and year 2, so potentially reflective of the slackening of the overall economic outlook. And it's the industrials and the apartments that have seen more of that growth rate being cut back. They're the sectors where rates have moved out to, I guess, record high levels, so possibly just taking a little bit of heat out of those sectors. The retail sector, when it comes to market rent growth rate, is actually kind of still trending upwards. So that's a sector arguably still in recovery mode, but that's because it saw some of the earlier cutbacks at the start of the pandemic. Offices overall, revenues are actually kind of net down really. Market rents are static, then you've got that kind of reduction of those forward projected growth rates, but more of the setback here is being picked up by the likes of the increase in costs and concessions on that side of the cash flow, and they're kind of being picked up more on those right two metrics. So let's start with the operating expense ratio. This, and we've explained it before, measures the change in the projected operating expense as a percentage of gross anticipated rent just for the next year. So it's still trending back down for most of the sectors there. So still a positive impact on value, picking up here really how those kind of revenue gains are still more than balancing out any escalation in operating expense. This metric, though, is still as though it's moving out the wrong way, you might call it, for the offices, and that's part cost escalation and part down to ongoing rental concessions. The offices on the right-hand side are also seeing larger than average increases in budgeted capital costs, which has a negative impact on value. This, I assume, is linked to the general realization of the need to invest more into some of these office properties to ensure they remain competitive in the wider real estate landscape. And with increase in, say, construction costs, that's becoming an even more notable pain point for the sector. So in summary, cash flow gains are being scaled back, but they're generally holding up. But rental gains are slowing. So it's a case of whether that increasing cost is going to become more of a factor as we look into the course of this year. And it's really the offices that are showing the most vulnerability in that regard. Before we get right into the detail of the sectors, I just want to kind of close off this section by taking a slightly different approach, looking at the numbers. So here we're looking at the percentage point change in values quarter over quarter. There's quite a lot of detail here, so just focus on a couple of factors here. So if you take this apartments, industrials, office and retails, if you look at the initial period of the pandemic, those adjustments to values ran at about 40% of industrials, up to about 80% of apartments, up to almost 90% of retails. Then you continue to see a little bit more bleed as you get into the next couple of quarters, after which you're kind of back to almost dealing with kind of reverting to type, dealing with property-specific distress issues, and then you have contrasting fortunes of the apartments and the industrials, with a lot more green on the board versus the office and the retails, with a bit more of a mix between those greens and reds. Then you get to the end of last year, and you get this big swing in terms of the vast majority of properties seeing some negative movement on values. And I guess what will be interesting to see is what occurs over the coming quarters, whether we continue to see majority of red share on the board, possibly as the country enters into recession, and especially if we're starting to see further rate rises by the Fed. So definitely one that we want to continue to keep a watch on. Now, just to close off this sector, Robbie, I think you had one other poll question here, yeah.
So that's the first poll: which sector will hold up the best over the next 12 months, right? So whether it's multifamily, industrial, storage, retail, or office. So I'm going to give about, basically, we're going to give about a basically 30 seconds. So. What do you think, Phil?
I think I know which one it won't be, but in terms of which one it won't be, it's a tough call. I mean, retails are obviously very best at the moment, but those cash flow fundamentals look to be holding out when it comes to multifamily industrials. So it depends how much, I guess, pure price adjustment those sectors continue to see. But yeah, I would be surprised if too many folks go for E anyway.
On the whole, we can see people industrial
Okay, interesting. So feels off the back of that that people maybe have got a sense that that kind of resetting of pricing metrics has maybe run its course at this point, and that those cash flows may continue to hold up. So let's move on to look at more of the individual details. I think I'm getting a little bit of feedback on the mic here. Hopefully that's not coming across too badly across the webinar. Let's get back to the latest quarter then. So just to explain the detail, and there's way too much detail on this chart, so apologies for that. So back to the overall quarterly returns, and we're looking here at how they're shaking across the major metropolitan markets, which we're ordering from west to east. This is kind of one of the cuts we take when we look at the attribution analysis we apply to the individual portfolios. We'll go into the sectors in a bit more detail. Just wanted to use this format to set some top level themes and to explain the color coding. So the color coding here is green and red, anything relative to that overall ODCE minus 4.1% operating asset return. So you get a sense of what's accretive or not to that overall index return. The table below is the same set of numbers but for Q3, and the bottom table is simply the difference between Q3 and Q4. So predominantly reds across the board as the vast majority of markets slackened off last quarter, culminating in that overall 4.5 percentage point decline in the overall ODCE index. Some top level themes on the top table: apartments and industrials, certainly more red on the card than we've seen in prior quarters, and clearly both those sectors, having been scaled back, instrumental in the overall setback of the ODCE return last quarter. But also what's worth noting is down below, relatively tight spread in terms of the movements of those returns from where they were in Q3, so kind of movements down in the kind of 3 to 5 percentage point range. Offices, go back to the top, they're predominantly reds across the card, and those returns have been lowered kind of over 5 percentage points over the last quarter, as much as kind of 7-8 percentage points kind of scaling back in returns. Retail's still negative rates of return, mainly when you're looking at that top table, but smaller adjustments when you're going down below, and the majority of those groupings now accretive to the overall ODCE, so still trending above the overall index return for the ODCE, as is the case with the alternatives. So that's one way of doing the color coding. If you focus here on the Miami office market, the other way we wanted to label things up is that's showing the return variance to the minus 4.1. The next slide color codes each of the markets, their return variance to their respective sectors. So you go from Miami offices being the red to being the green, because they're still trending above the overall office market. And this is the kind of detail we want to get into, where the variance is within each of the individual sectors. So let's move out that middle table. Let's get into the detail of the apartments. So the color coding here on that top table, all relative to that minus 4.1% return for overall apartments. Down below, you can see returns are down across the board. Main talking point for apartments has been that power shift between the kind of gateway and the improving Sunbelt markets. Maybe a little less apparent this last quarter, but we're still seeing that play out in the results. San Francisco, minus 5.6%, still struggling. DC, New York, Boston, LA as well, all below that overall multifamily average. And whereas you're seeing places like San Diego, Inland Empire, Miami, and Atlanta, all still holding out comparatively well. If we're looking for evidence where markets may be becoming slightly overheated, Phoenix there may be a case in point. Also in that other grouping at minus 4.5%, there's a fair bit of Sunbelt within there, so possibly coming off their best, so to speak. To get a better sense of the hierarchy, we then delve into the details in terms of just taking the appreciation element of that return for the quarter and break that down into those yields and the cash flow metrics. First point to note, negative appreciation across the board. It's really those yield movements that have been the influential part behind that value scaling back. But there isn't a clear variant across the order of that hierarchy, really, when you're looking at that yield metric. And really what's afforded these markets to the top a little bit more protection is a bit more of the strengthening of that overall cash flow piece. And those markets at the top, possibly seeing a little bit more improvement in those face market rents, and a little bit less scaling back in terms of those forward projected rent growth rates, whereas low down the hierarchy, smaller increases in market rents and larger reductions to those forward projected growth rates. But still, only Phoenix and So just a slither of an extent, San Francisco, where cash flows are down over the quarter. So pricing aside, I guess, Robbie, apartments still to be kind of look to be holding their own in that respect, or would you expect to see some scaling back of cash flows in the multifamily sector through the earlier part of this year? Maybe as affordability issues creep in. I don't know if that's what's holding things back in Phoenix, but also thinking about the gateways, will they continue to lose their appeal? That certainly seems to be the case there with San Francisco. So maybe just your thoughts around that, Robbie.
Yeah, I don't think it is affordability a factor completely, right? So if you look at it as well, like if you look at rental versus home buying, right? So the home with interest rate moving from like 3% to 7% is even more unaffordable to buy a house today, right? So basically there's support basically on the apartment side, the multifamily side, right? So we're not saying that there's no affordability issue. That definitely there is affordability issue in the US, but people still have to live somewhere, right? So and the other thing as well, we kind of heard about like there's a lack of housing in the United States. I think some Ferris article talk about 2 to 8 million kind of housing shortage, right, in the United States, right? So they'll provide a lot of the benefit, a tailwind to the multifamily sector, right? So I think that some of the near-term effect is basically more supply side in some of the market. Like a perfect example is Phoenix, right? So if you look at Phoenix side, you can see that Phoenix it definitely there's one of the hottest market, right? So one of the hottest market, there's a lot of new construction going on in there, right? So, but as a result, basically, you look at it, the vacancy move up from like from below 6% in 2021 to basically over 8%, right? So when that happened, you're gonna see the basically slow down in market rent growth, right? So therefore, negative cash flow effect, right? So in San Francisco and some of the gateway market, that's kind of the return to the office is not kind of help is not bringing people back fully, especially San Francisco side. And now you add on kind of the uncertainty with the tech layoff in there as well, right? So that's definitely kind of what impacting the San Francisco side. I think that if you go to the next slide, Phil, right? So I think there's a lot of question. How is Sun Belt market going to perform, basically, right? So the next one, right? So basically using Stratum Analytics, we're trying to see whether the migration is still going on or not in 2022, right? So you kind of using mobile data side is still showing that the Sun Belt still seeing a net migration, right? So in 2022, right? So they're moving out from New York, Chicago, basically, and some California market, right? So, and you go to the next slide as well, Phil. Basically, again, the job growth are still pretty strong. Granted, it's the last 3 years, the past 36 months. You got job growth, you got migration. So basically, Sun Belt still look pretty good on the demand front, right? So once you kind of pass through near-term supply, I think the near-term kind of demand for the apartments seems holding up.
Thanks very much there, Robbie. And actually, just one other slide in the deck here. I think we had one on a 1 year view, which kind of just goes back to reconfirm actually the variant that's out there in the market between those gateway markets down below. This is appreciation on a 1 year basis versus the appreciation up top on a lot of those sun belts. And the variant isn't down to the movement out in yield. It's very much down to the changes in the underlying cash flow trajectories and the strengthening around those sun belt markets. Stronger improvements in those market rents, pricing kind of 3-4 times as much as in some of those gateway markets. And so they're certainly on those gateways where those kind of cash flow improvements are a little bit more muted. That's what has been cancelled out by those movements out in the yields, leaving values pretty much static or on the way down over the course of the last 12 months. Let's pivot across to the industrials, which I've now just boarded up there. See for the lower table that returns were pretty much down across the board, culminating in that over 5% reduction in total returns for the sector. Turning to the top table, I must confess I kind of started to struggle to determine too many themes out of this latest quarterly set of results. Overall, I think the downturn looks to have presented more of a kind of leveling out, I think, of performance across the industrial markets. In prior quarters, we saw phenomenal growth in the likes of Inland Empire and New York. They have now back and aligned with the overall industrial average. I mean, some of the coastal markets, LA, there in green, Miami, still holding out better than average. We're starting to potentially, I don't know if it is, Robbie, kind of pockets of oversupply emerging. That number there for Denver looks pretty low. Also Phoenix as well down there in the red zone. But generally we're seeing more of a leveling out in performance across the industrial markets. That really comes out when you break out the appreciation. If you leave Denver off the table, you pretty much got reductions on the appreciation side between about 4 to 5% across all these markets. Pretty uniform in terms of that yield offset. On the upside, we're seeing positive cash flow still. So we're getting that market rent, although it's being scaled back by reductions in those growth rates, we're still seeing some protection to cash flow in the order of 2 to 4%. So, and only really Denver where cash flows are down over the quarter. So how do you see the kind of state of play in the industrial sector at this point then, Robbie?
Yeah, I think on the industrial side, definitely there's a talk. There's a slowdown from Amazon leasing. We all heard about that, right? So, but on the other hand, if you look at online sales, are still pretty strong. Even Amazon holiday sales kind of hit record high again, right? So there still seem to be some demand side that kind of on the demand on the industrial spaces, right? So and the other thing as well, I think that the vacancy is still really tight generally in most markets. You look at the national vacancies reported around 3.9%, right? So I think some of the market, if you look at it, the Denver is perfect example of market with supply issue, right? So the vacancy is 6.1% in Denver, so basically call it more than 2% higher than national averages, right? So there were about 8.6 million square feet in 2022, with additional 10 million square feet under construction, right? So I think that's a little bit more on the market by market specific, right? So overall, investors still feel pretty positive about industrial sector in general. So that's why we start seeing a handful of transaction in industrial in 4Q, right? So in the Inland Empire and Seattle area, and the cap rate was pretty competitive in that market, right? So we saw Inland Empire like a 3.8 cap rate for 2022 year build. Basically Seattle area, kind of like even some of the long walled asset, low 4 cap rate for newer building. So if you look at it, this deal, a lot of cases closed, some of them is like late to mid-December. One would argue at that time you're negotiating, you look at 10-year treasury, you're basically around like a 4.42% range, right? So you add on 200 to 250 basis point. A lot of these deals would have been negative leverage, but I think that overall people still feel pretty comfortable with the industrial investment.
And what about how returns might shake out across the different markets? I mean, obviously we've seen quite a lot of a spread there. And when you go back to 21, do you think that we'll go back to a period where some of those markets continue to lead again?
Yeah, I think again, it's the overall supply side, right? So which mean that the market with a tighter supply, it's similar to when the initial rise of the industrial, the coastal market where it's hard to build, right? So where the supply, basically there's a very tight vacancy, that was kind of, we expect it to perform better as well.
Okay, yeah, and we can certainly see that if you go back over the last 1 year here, where you've got those kind of coastal markets, Southern California, New York, all strong levels of appreciation for last year. And if you look at that kind of underpinning of that cash flow, supported by that improvement in market rents for a number of those markets are up over 30% over the course of the year. So still incredibly strong in that respect. Let's turn to the other side of the coin, then the offices, arguably the most challenged sector at the bottom end of the hierarchy. Returns here reducing down to, for the quarter, -6% for Chicago, further adrift, -7 for Phoenix, similar -7 for LA, and kind of sub -8 for Houston and DC. And I think most markets there are kind of in that kind of below -5% territory as well. And if we unpick those performance levels, the value setbacks, as we noted when we look at things at an overall sector level, are part down to pricing, those orange bars, but also down to the contraction of the cash flow side of things. So yes, that yield change is pretty broadly based. When you look at the order of magnitude of the yield offset, a bit maybe a little additional market specific risk being priced in as well. But it's the cash flow projections that are down across the board, and that's where you're picking out the major variances across the market. So the worst affected down the bottom in terms of cash flow contraction, kind of DC, Houston, Phoenix, LA, also Chicago to a certain degree. And there are a variety of factors, I guess, coming into play here, aren't there, Robbie, with kind of more vacancy, more of those near-term revenues down as concessions become increasingly commonplace. Then you have the inflationary pressures, I guess, that are being played out in terms of escalating outgoings, both on the operating and the capital side of the equation. So there's still just a tip of the iceberg. Robbie, do you see kind of further kind of challenges on the cash flow side, and maybe thinking how things go relating to how things have played out also over recent years as well?
Yeah, I think on the office, it's definitely the one that the toughest one, right? So the most unclear, there's no clarity to the office to some extent, right? So we look at it same as we kind of mentioned previously. Office is the new mall, right? So you're kind of going through kind of the past that's similar to the mall valuation previously, right? So in here we can see that there's a relatively large kind of yield effect, but at the same time, cash flow being negative as well, right? So the most common adjustment we kind of look at is the general vacancy factor. Right, so we know the occupancy in office can continue to decline, but the question is like, what is the stabilized occupancy for an office today, right? So there's continued to be the highly debated, right? So so therefore you see more and more kind of like cash flow being put with higher vacancy. To some extent, that discussion should be incorporate static vacancy in office, right? So but yeah, so that's definitely on that basis you see a decline, especially commodity office, right? So I think the other thing as well to kind of look at is like, is office decline, is it really a decline? What's going on with, if you look at an overall basis, it doesn't seem to be declining enough, right? So if you look at the 3-year chart, Phil, on the next slide. So if you look at it, right, so definitely that's basically on that slide, on the 3-year side, you see that basically 5 market already, there's more than 20% decline, right? So on that basis, right? So there's definitely some market that continue to see that decline in the office valuation. The one that holding steady is basically more our kind of last 3 years have been the life science market, right? So the life science and medical office market, right? So that's kind of on the top of the chart.
Yeah. And the other dynamic that plays out here is also when we're looking, and we dug into this a little bit more detail, the difference between some of the near-term geographical variances, looking at the suburban versus secondary business district, the urban and the CBD. We're indexing here the appreciation going back to the start of the pandemic, and as you can see, get to 21 and 22, that suburban office stock was still rising in value from where it was at the start of the pandemic. Contrast that, as you mentioned, Robbie, with the downtown, the CBD, which have been continuing on a downward trajectory, kind of lowering more so than the suburban space. So there's a bit of that variant to consider within these numbers. The other side of things, and it's a little bit early to make a judgment call around the precise impact of this, but we're taking this data out of the NCREIF query tool. I say that the work hasn't yet been fully finalized in terms of separating all this out within the ODCE funds, but we've separated out using the query tool, the life science, the MOB, from the wider office market and looking at that appreciation index series. And you can see that, I mean, phenomenal there. The values up for life science, up 40% over that 3-year time period. MOB providing a defensive option, but those values are pretty much holding steady when you look over a 3-year. Contrast that with the overall office sector. On to just finish off with the retails then, where we look at things in terms of the different sub-property types. So yields widening across the board, as we're seeing in the other property sectors, and that's what's really brought down the value. Cash flows on a total retail basis, then still kind of seeing some upward progression, but we're seeing some variant around that. Power centres, community centres, really only holding their own, and down the bottom there, regional malls starting to look a bit more vulnerable again. So I don't know, what's your thoughts on the state of play with regard to the retail sector, Robert?
Yeah, I think on the retail side, basically, we all know that retail taking a beating, right, in the past kind of 3-4 years now, right? So do I look at as well that retail is basically now in a sense more stabilizing, and then the other thing as well with current recession, inflation, that's helped kind of grocery anchor part of it, right? So the neighborhood center is kind of generally holding a little bit steady, right? So and then we are here as well. The luxury retail still perform relatively well, right? So that's why you're seeing that fashion and super regional mall are doing kind of pretty well on the positive cash flow side, right? So I think going forward, it's definitely continue to be a question mark. So what happened happened with recession, what happened with slowdown, will that impact retail more? Like on the other hand as well, inflation typically help with the sales side, right? So that's definitely something we're going to continue to monitor as well going forward.
Okay. And if you look at things on the retail sector on a 3-year basis on this slide here, you can still see that there's clearly still ground to be made up over the period of where things were at the start of the pandemic, both from a pricing, but also from the cash flow side. But going to your point about the grocery anchors, that is the kind of one pocket where we're still seeing a degree of resilience when you look back over the course of the last 3 years. So that's pretty much all the detail I think that we had to go through today. So hopefully that was helpful and useful to pick through that information. Just some closing points here in terms of some kind of headline themes. Yeah, negative rate of return. I think that we saw from the polling questions, there's no surprise that the market is on a downward trajectory, given the kind of reduced sentiment around the economic fundamentals and that increased cost of capital. But this does follow a kind of growth spurt, and that's when we had that disparity across the market. We're now getting more of a leveling out across the property types. So return variances are starting to become much more about property specifics. So it's the increased cost of capital that's behind really the declining values. I guess what people are watching really are the cash flows. They are possibly showing some vulnerability, especially I guess if operating expenses start to continue to escalate and rental gains ease off. But at the moment, with the exception of the office sector, those cash flows are still, and let's call the phrase, just holding up for now. I think we had, just to finish off with another polling question there. Obviously, you want to take that and then see if there's what questions we have in the Q&A box.
Sure. So yeah, so this is similar to last quarter and every quarter before, right? So we kind of, what do you expect the total unleveraged property return to be in 1Q 2023, right? So noted it's like about negative 4.1% in 4Q, right? So is it going to be some positive value movement? So is it going to be -2 to +1? So i.e. appreciation is being kind of less than -3? Right, or it is -4 to and -2, which mean that the appreciation has been -3 to -5, or is it below 5%, right? So we'll give about maybe kind of 30 seconds to 1 minute for people to pick. Definitely it's going to be an interesting one, right? So again, if you're trying to guess, Phil, I know that it's kind of hard to guess what they're going to be. What will you think, Phil, what people will pick?
Personally, I'm suspecting it's going to come in on those two bottom brackets of C and D. If we look at the form book, if we say C, it'll end up at D, the last couple of quarters. But I wouldn't be surprised to see similar write-downs to value, especially if the economy continues to weaken. But I guess it depends on the movements out of the Fed as well.
Let's see what the result is. So it's B and C, so it's very similar to last time, except that the C actually dominate more. So i.e. majority, 51%, believe the appreciation is -3% to -5%, right? So and then about 38% believe that the total return will be -2 to +1. So i.e. appreciation between 0% to -3%. So, but yeah. That definitely kind of similar to last time. So we'll see how that end up.
So I think we've got a few more minutes left on the clock. So I don't know if there's any questions that come through the wires there.
Yes. So I think the one question that people brought, and then I know that question occurred last time as well. What sector are included in the other category, Phil?
So yeah, and I made the point earlier on. So the other category is the one that NCREIF are reviewing at the moment. So at the moment, it's the majority piece of that. I think about 60% of value. We can definitely kind of qualify this as self-storage. So there's some senior living and healthcare in there as well. But there will be some life science and MOB assets in that as well. So what NCREIF are trying to do is clean that out to make sure that the life science certainly kind of falls into either the office or the industrial bracket, and the MOB definitely sits within the retail side, sorry, the office side of things as well. Student accommodation is mainly in the apartments, but there are some student accommodation assets also in that other. So it is a bit of an eclectic mix, but it's mainly the self-storage. About 60% of that is self-storage.
I believe the SFR in there too, right, Phil?
Yeah, sorry, yeah, SFR will be in there too. You're right there.
And the second question is, maybe that's for me, right? Is the market rent outperform for certain office market, primarily concentrating on Class A trophy building, or more broadly? So I think the answer is, we all know, like in the office side, there's have and have not, right? So we hear the news all the time, especially like that the super trophy office building in New York City keep getting rent that's kind of outside really high, right? So 150 to 200 bucks per foot, right? So you can see that some of the trophy assets are still seeing an increase in rent, right? So, but I think that some of the market is definitely more on the, like some of the market that show an increase in rent are typically an actual lease sign in some of that market, right? So that's kind of performed a bit. It's typically a smaller market here and there. But overall, like I think the market is basically, it's kind of hard to look in the market rent because what you're seeing here is just face rent, but in reality of it, there's kind of free rent, there's very high TI now being included, so you can see the capital cost being increased, right? So and a longer lease up, right? So TI, basically the net effective rent definitely down more significantly in the office side. And the other thing, the other question is basically, with the long-term rate have settled, do we expect the metrics to settle as well, right? So I think that's kind of again, that's a big question out there, right? So with interest rate now settled at 3.5%, spread have come down. We see basically, for example, some of the increased activity in industrial. Like when you feel the market you believe in, people start going in there. The other thing as well, we start seeing more fund forming. Like so, there's a lot of new funds being forming in some of the market that they believe in. So we see forming of the fund in apartment sector, especially affordable apartment. Right. So you can definitely see that the dry powder is being built behind the scene as well. Right. So. Again, I think that's some of the asset, like for example, an office is still unclear basically what the cash flow look like. So you're going to see continue kind of potentially downward movement still in the office side. But the other sector, you're definitely seeing some people are willing to jump in to that sector already. Let me see if any other question, please enter them in, right? So, but so far right now, that's the question that I have. Let me see real quick.
If we get any more, we can always send back a Q&A document to everybody.
Yep, that works.
We're pretty close on the hour. So, well, thanks, Robbie. It was interesting going through those numbers. Definitely, I'm sure there'll be further conversation in the weeks ahead as we head out and talk to the clients that we're analysing this data to get against on a one-to-one basis. So, very much looking forward to those conversations. Thank you, everybody, for dialing into today's webinar. We appreciate everyone's interest in this analysis, and we look forward to kind of updating you again in 3 months' time when we start to look at the opening 3 months of the year. So thank you very much, and everyone have a good rest of the week. Thanks a lot. Thanks, Robbie.